Raymond Thomas Dalio, born August 8, 1949, is an American billionaire investor and hedge fund manager. Ray Dalio has made his last warning and prediction on the U.S. collapse in this video. Ray Dalio successfully founded the world's largest hedge fund, Bridgewater Associates, in 1975. He is the author of famous books such as Principles for Success and The Changing World Order. You can get a free copy of his most popular books at the end of the video. How bad will America collapse? What could cause the U.S. downfall?
Ray, back in September, you said that the United States, you think, will be facing a debt crisis. The yields have changed pretty dramatically just in the last week or so. You still think that that's the case?
You have a change of 50, 25 basis points and so on. Let's just go back to the basics and the big picture. First of all, let's take the bond yield. The bond yield, roughly speaking, has got to be about what we determine the expected inflation rate will be over the period of time. That number probably is settling into the vicinity of 3.5%. That's the right number. There has to be above that a real interest rate. In other words, for those who are holding debt assets, they have to receive a return above the inflation rate by something probably in the vicinity of 1.5%, 2%. So that is going to get you in the vicinity of 4.5%, 5% interest rates. And you're seeing the movement around that level. Then there's the big question of the supply-demand for bonds. In other words, the government produces a certain amount of bonds that are in size that is equivalent of roughly the size of the deficit. That means they're going to have to sell a lot of bonds, okay? And then we look at who are the buyers of those bonds and do they have an adequate appetite? And that's a big risk, because we have many who own those bonds have had losses in that. That's not just banks, that is central banks, that is Japanese investors and so on. And so there's a supply-demand issue. You'll have these wiggles around there, but those are the fundamentals that will drive it. So as we look forward, we have a debt problem, because you can't keep adding to debt faster than you add to income without that problem. So we're seeing the need for the rise in real interest rates so that the creditor gets an adequate return at the same time as we have a supply-demand balance. So that's how it looks to me. What's happening in the economy is that a lot of money was sent out in the form of checks and the like, and went out to a lot of people, and so the household sector did well, because the government sector did poorly. They got themselves in deeper debt intentionally so that the household sector and the business sector could be better off. And then there's the rise in interest rates. What happens from that is that savings of money gradually goes down, and also the debt maturities, as they roll forward, gradually go up and create a squeeze. So there's an emerging squeeze happening. However, because the unemployment rate is relatively low, and because the compensation levels have been relatively high because of that set of circumstances, the household sector's income has been good. So you have a sector in the household sector, hence the economy as a whole, and I'll include the business sector in that, in which by and large the financial transfer of wealth from the government as it got in debt and gave it to the public sector, gave it to the private sector. That is a formula for a gradually weakening economy, not a big break in the economy, a slowing of that economy. Right. I think that's what we're seeing. And as a result of that, that's what you're seeing in the bond market, as there's a bit of a slow ease within that range.
Play this out a little bit longer, which is to say, where do you think interest rates are a year from now, on a very just straight up basis? But then even longer than that, you're talking about the debt problem that we have in this country that's becoming a main feature of debate and a topic, of course, in the presidential election and what's going to happen come November 2024 and beyond.
As far as the question of where the rates are, I think that most likely, I think the rate structure is going to be staying at its level, perhaps slightly less, but there's a range of uncertainty around that having to do with the supply-demand question. We're now at a period of time where the supply of bonds to be sold will be start hitting the market. And now we have to see the demand issues of that, and that'll be around there. I think that probably in the vicinity of, I would say somewhere in the vicinity of relatively flat. I don't think there's going to be any important change in the Fed policy other than maybe a slight easing as the economy slows down. I think the thing to realize is that the economy will likely weaken. In other words, its growth rate going to something close to zero, plus or minus, maybe 1%. And with that exerts a slight downward pressure on interest rates. At the same time, the supply issue becomes an important issue.
The longer-term damage of having this enormous amount of debt, obviously that's playing into the political debate. But it sounds to me you're also arguing that if we're going to have a soft landing, that maybe people are going to feel more comfortable holding as much debt as we do, and that the rates are not going to, blow through the roof.
No, I think we're talking about the short term as very distinct from the longer term. The short term we just talked about. The longer term is that we are at a point in which we are borrowing money to pay debt service. And there is a process by which when you keep having debt growth faster than income growth, then that means that you have debt service encroaching on your spending. It's the same for the government as it is for us. And as that happens, and you want to keep spending at the same level, there is the need to get more and more into debt. And the way that works, it's like it accelerates. We are at the point of that acceleration, which creates the supply-demand problem. And it's made worse by the other issues that we're talking about. The internal political issue, the internal social conflict issue there is something that is affecting foreign demand for bonds. For about 40% of our debt is sold to foreigners. And so there is a concern of the American politics, of the controlling of this debt crisis, and these types of things. So we come back to the same basic question. How strong are we going to be? When we talk about strong, what I mean is also economically strong. And economically strong means financially strong. That means it's just a basic thing. Financially strong means, do you earn more than you spend? Do you have a good income statement as a country? Do we have a good income statement? And do we have a good balance sheet? More assets than we have liabilities. The worse that gets, the more we are going to have that long-term problem. And it's just, you can see it in the numbers. It's just a matter of numbers. We are near that inflection point.
Do you think the United States can control its fast-growing debt? Which politicians will cause the U.S. collapse? Get a free audiobook of Ray Dalio's best-selling books in the description or comment below.
Do you want to retire early? Do you love freedom? Do you want to work only 1 to 2 hours a day while traveling around the world and spend more time with your family? You can start stock investing and option trading right now. If you want to know more about finance, stocks, options, real estate, crypto, check out our playlist. Stock investing, stock trading, option trading, real estate, cryptocurrency.